Good morning. I'm Tim Nyland, Director of Research at Pacific Point Advisors in Rancho Santa Fe, California. Together with my team of analysts, we've built out a state-of-the-art research lab that will bring you a unique and timely perspective of analytical issues of relevance impacting financial markets. Before we get started, please like, comment, and subscribe, and be sure to visit the Pacific Point Research Lab on our website at pacificpoint.net/research-lab. And while you're there, be sure to sign up to receive our research delivered directly into your email inbox. Today, we're going to follow up from last week on recession risks. We're going to dive a little bit deeper into U.S. corporate margin cycles. But first, for context, please allow me to provide commentary on updated macroeconomic charts since our last webinar. Let's go ahead and get started. In our last webinar, I showed the 35-year history of the 10-2 Treasury yield spread, specifically commenting on the depth of the inversion to levels that we hadn't seen since prior to the dot-com bust in the early 2000s. I also commented on the fact that these things take time, and once these yield spreads invert to these levels, it traditionally takes about 12 to 18 months before we actually enter into a recession. So again, I like to relate this to the child in the backseat of the car on a road trip screaming and yelling, "Are we there yet? Are we there yet?" Just remember, when looking at these charts, these things do take time to play out, okay? So we need to have patience. The next slide, what I want to do is I want to shorten this time frame down to just a year and show you really what's going on here with this most recent inversion. Really, it started at the 1st of July, and you can see that we still remain inverted, and I believe this is as of August 23rd, so yesterday's close. We're still inverted to the tune of about 23 basis points on the 10-2 Treasury yield spread, okay? So what does this look like from a yield curve perspective? This is something that I didn't show in our last webinar. I wanted to take a moment to explain how to actually read the yield curve because many people struggle with this. A very simple, the easiest way to do it is remember that this is not necessarily a time series chart, okay? So you can't read it like a traditional, price and earnings type chart with a time series across the bottom. What you have across the bottom, what we call the tranches of the actual U.S. Treasuries. So you've got your 1 year, 2 year, 3, 5s, 10s, 20s, 30s. And the time series itself is actually plotted here on the y-axis. So you can see the blue line is the previous close, the 1 week, the 1 month, and then we can see what a healthy yield curve actually looks like by looking at the year ago yield curve. So the idea here is that a year ago we had a nice positively sloped yield curve, and this is a traditional yield curve shape for what we would call a more healthy type macroeconomic backdrop. And what we have more recently is what we call this inverted yield curve, and you can see it here as simply the 1s, 2s, and 3s inverting against the 5s, 7, and 10. Specifically, we like to look at the 2s to 10s, but it's really nice to be able to look at what that trend has done over, say, the past month or so. And you can see that yield curve inversion hasn't really gotten any better. If anything, over the past couple of weeks, it's gotten worse. It's only really moderated here in the last couple of days. Okay, so that's what it looks like from a Treasury yield curve inversion perspective. And just remember, the reason why this works so well is that at each one of these tranches, the pricing of U.S. Treasury securities themselves is actually dictated by supply and demand. So you can get these really, really crazy inversions and shapes to the yield curve. But just remember, when everybody talks about a positive sloping yield curve being the most healthy, that's what we had a year ago. Again, this is where banks make more of their net interest income. Again, just a much more positive environment overall. So in our last webinar, I showed this 50-year history of headline CPI, the percent change. Again, this is a 1-year percent change coming in at 9.1% for June. And I have the updated July point. You can see what everybody got excited about, that perhaps, again, I'm going to stress perhaps, we don't know for sure, inflation has peaked. Okay, we've gone from a 9.1 print on headline CPI to an 8.5. And I just want you to see what that looks like in terms of context, right? Very, very common prior to recessions for the CPI to really take off. And that's what we've got going on right now. And you can see that in much more extreme levels than we had even prior to the Great Recession. Okay. So the idea is, how do we actually utilize this information in our analysis? It's great when we read the Wall Street Journal and we listen to CNBC and we hear everybody say, oh, CPI is coming down. Okay, that's great. But we need to have some sort of context for which we can actually reference this information and actually make decisions. What I like to do, and what we like to do at Pacific Point, is we like to take a look at this relative to commodities prices. We know that commodities prices are a very large driver, at least of headline CPI. Remember that the more sticky CPI comes in the way of owner equivalent rents and wages. But specifically, this particular chart up on the screen, and we're starting out by utilizing the FactSet system here. This particular chart is one that we really like. This is, again, showing you that CPI all items at 8.5, along with the producer price index. But most importantly here, what I have up here in this plum colored or purple colored line, this is the actual commodity price index. And what I want everyone to see is what all the excitement has been here as of late, and everybody talking about how commodities prices have come down, and they have, and it's actually contributed to that decline in the overall headline CPI number. But what I want to make sure to stress is that even despite this decline that we've experienced here in July, we're still sitting at levels that were considered peak levels prior to the Great Recession. Okay, so even though we've had a decline on a year-over-year percent change basis, we're still sitting at peak levels that we were sitting at in 2008 prior to the actual Great Recession, or I should say at the start of the Great Recession. Okay, so this is really important to remember, that we still have to have a lot of pressure come off of commodities prices to get us back into that normal type range. So we've got a lot of work ahead of us here, but this is a good start. Okay. And the next slide is another one that we showed in the last webinar. And again, very briefly here, this is where we start really getting into applying CPI to what's going on with the employment picture, and then taking a look at the labor productivity specifically, to be able to take all of this information and try to determine how it's going to impact U.S. corporate profit margins, and to be able to look at where U.S. corporate profit margins are today to see where they might be headed in the future. And this is really where the rubber hits the road. So what I want to do is I want to go to the next chart, because this is the June data, and we already spoke about this in the last webinar. And we'll go ahead and do a full review of this chart with more recent data for the July point, which is what I've got here. Now, what I want everyone to see is the blue line is the CPI number, and obviously that number has updated from that 9.1 to that 8.5. But I want you to pay particular attention to some really bad news that we got, not only from the U.S. corporate profit margin perspective, but this is a number that the Federal Reserve does not like, because it really puts pressure on that labor component of inflation, is this labor productivity plunge. I don't think we were expecting that labor productivity number to collapse that far. So let me go back to the June reads just so you can see where we were. And then in the July read, that really extended itself to record low levels. So again, what does this type of information mean, and how do we actually utilize this? Remember, this is one of the two really sticky components of inflation here. This is a number that the Federal Reserve doesn't like, and this is the average hourly earnings of all private employees, okay? And so average hourly earnings are clocking in at about 5.2% year over year. And again, remember, in all these charts that I'm showing here from FactSet, I'm normalizing all of this information on a 1-year percent change basis. Really the only way that we can make reasonable comparisons, remove seasonality, and make reasonable comparisons across these types of metrics. Otherwise, you just get a bunch of positively sloped lines. And I guess in the case of labor productivity, you'd have a negatively sloped line. But at any rate, really hard to make any sort of inferences if you're not transforming the data to a 1-year percent change. So that's why we do it. So what's happening here is that we've got a little bit of a decline here in inflation. And the real issue for US corporations is they're having to pay their employees about 5% more on average each year. And the amount that they're actually able to produce is actually declining to the tune of about 2.55% now. So that puts more pressure on the labor market, right? Employees are producing 2.55% less units of output than they were previously, which means that in order to keep up the same level of output, US employers or US corporations have to go back to the labor markets and hire more workers. And so that continues to put pressure on wages, and that's not a good thing. So when this inflation number ultimately cools, and we expect that to happen, the idea is that US corporations may not be able to continue to raise their prices, may not be able to continue to pass along these higher costs. Even though these costs are coming down, they're going to be saddled with this stickier, longer term wage gain that they've given out to their employees. So this is what leads to the actual cycle, the margins, the operating margin decline, and ultimately layoffs at US corporations. So in order to determine whether that's really a reality or not, I mentioned this last time on the webinar, and I've actually got charts to back it now for you. We're going to take a look at S&P 500 margins, and the next slide is going to really show you where we're standing here. The S&P 500 margins are sitting at a cyclical peak. So I'm switching over to some Zacks research system charts now. Utilize Zacks for their composite capabilities, and you can see that we are sitting at about 14% revenue growth, and that's on the decline. So we've actually, from an aggregate market weighted S&P 500 perspective, we actually have already made the rollover in top line revenue growth. And it's really nice that we've got this most recent June point in the database now that we're working our way through earnings season. So we've got this most recent information to look at. And what I want everyone to see is how similar it looks to some of these periods prior to the recession in 2001, and then obviously the Great Recession. And even it looks very similar to this recovery that we had here. And a lot of pundits are going to point to the fact that we had this cyclical peak in margins after the Great Recession, and we were able to recover just fine. But I want to point out that the macroeconomic environment was much different here. Back here, we actually had from 1998 to 2000, we had interest rates increasing, so a very similar environment to what we've got now. Same thing here, heading into the Great Recession. But here we actually had multiple rounds of quantitative easing that actually helped these margins more or less stabilize, if you will. So we went through this super steep decline in revenue growth, and we normalized out with a peak, and then we were able to continue to normalize for the next several years through rounds of quantitative easing. Not sure we're going to get quantitative easing at this point, just given where we're at with the Federal Reserve really aggressive on fighting inflation. So we've got a much different story on our hands now, right? So we've got revenue growth rolling over, we've got gross margins rolling over, we've got operating margins rolling over, and obviously we've got net margins rolling over. So really sitting at a cyclical peak here for the S&P 500. And the idea is, how far is this going to go, right? How aggressive is the Fed going to be? How sticky is that inflation component going to be? And obviously at this point, the Federal Reserve is probably pretty pleased with where commodity prices are headed, and not so pleased with what's going on in the labor market, as well as the real estate market with owner equivalent rents and their impact on inflation. So this is really going to hit the top line and revenues, and really going to hit operating margins hard. Again, that labor component being very sticky for operating margins, I would expect this to roll over. The question is how far it's going to go, and will it ultimately flatten? So if we can achieve some sort of normalization around that median 6.7 level of annual revenue growth, and then come down and at least flatten out at somewhere around the median 19, will get us some sort of stabilization for the S&P 500. So that's what we're looking for. That's what we're hoping for. And what I've done is I've cherry picked some sectors that I think you'll find very interesting. The S&P 500 energy sector, you can see that despite this incredible run that it's had, 65% year-over-year percent change in revenue growth, that it's actually rolling over now as well. And even so, we're still able to increase gross margins, still able to increase operating margins, still able to increase net margins. So pretty remarkable contribution to the S&P 500. So we're still getting a margin rollover even despite these increases along these margin numbers. Healthcare sector has been a solid contribution to the S&P 500 as well. It's rolling over as well. Okay, you can see that here in the charts. So really, outside of energy and healthcare, I mean, these are obviously your two bright spots as far as contributing positive growth in gross margins, operating margins, and net margins. You'll see in the next slide that information technology, literally that revenue growth has been cut in half since those COVID gains that we experienced. So we had revenue growth in excess of 20%. We're now clocking in at 11%. And you can see those margins rolling over as well. Okay. So effectively what we're doing when we're doing this type of margin analysis is we're just kind of diagnosing, what's going on with the income statement or the P&L statement for, in this case, for the information technology sector. So when we've got this revenue growth on the decline and we've got gross margins obviously on the decline, you can see that the IT sector may have benefited from some easing in commodity prices, but now it's starting to catch up with them. Not only is a decline in revenue growth, but perhaps the ability to pass along those costs no longer able to, and those gross margins finally rolling over. And you can say the same thing with operating margins, right? This information more or less trickles down to the operating margin line. You combine that with employee costs, and then you get this rollover getting a little bit more extreme, and then ultimately down to the net. So your non-operating income, taxation, and obviously the concern is how far is this going to go before we stabilize? Okay, so we are at cyclical peaks. We are rolling over, and it looks as though there really isn't any sector that's immune to this. Okay, so the S&P 500 utility sector margins. This is a really, really interesting one. And, a lot of people, a lot of consumers are falling behind on their utility bills. They continue to raise rates. Revenues are still on the increase, which is incredible for this sector. But look at what's going on with your margins, right? Even despite the fact that you're sitting at record high levels of year-over-year revenue growth, you've got margin slippage, right? We're now down well below our 25-year median on gross margins. We're sitting at median on operating margins, but you can see the cost pressures that have built for the utility sector at large. So to the extent this revenue number begins to roll over, you can expect this net margin to continue to decline as well. We've already got all the pressures from the input costs as well as the operating costs here, and you can see that. Okay, I've saved the best for last, and this is the S&P 500 materials sector. And when I first looked at this, the interesting thing was, first thing that came to my mind was, the roller coaster at your local theme park. And you're clicking up, and then all of a sudden you're getting ready to take the plunge. These are some extreme levels for the materials sector. You can see the cyclicality in these margins, specifically revenue growth and how that can translate to the cyclicality in gross margins, operating margins, and net margins. To the extent this revenue number begins to roll over, you're going to see all of these levels of margins begin to roll over. And according to the research that we've done, it looks as though for a large majority of the materials names, it's more of a volume. They've been able to pass along price increases, but volumes have dropped off substantially. And that's what's leading to these declines in revenues. We saw that specifically with Ball Corp. We reviewed the transcripts and sat in on the earnings call, and that's in fact what was happening with Ball Corp specifically. And we've seen it with other companies as well. So anyway, something we're keeping our eyes on, and you should as well. Be advised, you're not hearing a lot about corporate profit margins right now, but I'm sure you will. Obviously, this is a canary in the coal mine for us as we're looking out towards the risks of recession as we're working our way through this business cycle. That's about it for today's session. Thank you for attending. I hope you enjoyed the explanations on how to blend macro trends such as CPI, PPI, commodities costs labor productivity, and average hourly earnings together with corporate margin analysis. Though you may have heard and read about these factors, seeing it in charts brings a whole new level of appreciation and context to the scenarios the Federal Reserve is facing in their fight to tame inflation. While U.S. corporations are on the brink of falling off record high U.S. corporate profit margins. If you have any questions or requests, please leave a comment or email us directly at info@pacificpoint.net. Be sure to connect with me on LinkedIn at Tim Nyland. To receive our research delivered directly into your inbox, please visit us at Pacific Point website at pacificpoint.net and click on the Research Lab tab and sign up to receive our research delivered directly to your inbox.